Hey, what's up everybody? It's Cameron here with themoneyventure.com. Today we're going to talk about 10 beginner investment mistakes to avoid. Probably the number one investment mistake that people make, and not just beginners, but everyone in general, is never starting in the first place. The reason that you need to start investing is because when it comes to the stock market, time is your biggest is your biggest ally and will be on your side. The earlier you invest, the more your money will grow and the quicker it will grow in the long run. To give you an idea, if you invest $100 per month for 10 years straight and get a 10% return, which is a pretty average return on the stock market as a whole, you will have over $20,000 after 10 years of investing just $100 per month. And it just continues to grow from there because of what's called compound interest. The second mistake that a lot of investors make is not choosing the right investment approach. There's essentially two ways to start investing in the stock market. The first one is called passive investing, and the second one is called active investing. A passive investing approach means that you're investing in funds, in mutual funds or exchange traded funds. This is an approach where you put your money in that fund and you basically set it and forget it. The second approach is active investing, where you seek out individual companies and pick which stocks you want to include in your portfolio. This takes more time, it takes investment research, and it takes a little bit of experience to get started. So before you start investing, make sure you know what approach you're taking. Most likely, most beginner investors will be investing in a passive manner. And as they get more experience, they can start looking at becoming more of an active investor if they so choose. Another common investing mistake is investing out of what a lot of people call FOMO, or fear of missing out. When you invest based off of an emotional decision, chances are your investment is being made on a bad foundational decision, or a bad foundation of knowledge for your decision. Investing out of fear of missing out on an opportunity often results in lost money, regretful investments, and just overall isn't a good long-term investment approach. Another common investment mistake that beginner investors will make will be investing out of greed, which is similar to the previous one we talked about, which is FOMO, or fear of missing out. But investing out of greed means that you're anxious to jump into something and you simply want to make an investment because you're excited about it, you haven't done a whole lot of research on it, and you haven't even really looked at your budget to see if it fits within what you're planning on doing. So investing out of greed, or just the want to get more money in the stock market, is a bad decision because you need to make sure that you have properly done your budget, that you've properly analyzed the investments if you're an active investor, and or you're not doing it just to get more money in and just to make a quick buck. Another big investment mistake that beginner investors make is selling their investments when they think that the market is tanking. As I'm recording this, we're still amidst the coronavirus pandemic, and a lot of people probably sold their investments the second they thought that the market was tanking. And of course, it did go have a downturn there, and it still has a pretty volatile market as we speak. But the reality is every market downturn that there's ever been in the entire history of the stock market has always come back and exceeded its former highs. And so the point is when you invest, you need to take your emotions out of the game and have a long-term mindset, because over the long term, the market continues to go upward and upward with short-term volatility in it, and those include downturns in the market based on different economic events. So keep a long-term mindset and make sure you don't sell your investments just because you're afraid that the market is going to tank for good, because that has never ever happened. As a beginner investor, It's often easy to see your money invested in the stock market, see it grow, say you make it a decent return, and then you come across that purchase or that brand new car that you want to buy, and you got the money, but it's invested in your account. The problem is a lot of people will end up just selling their investments on a whim to make an impulse purchase, and that erases the entire progress that they have made thus far, and essentially you have to start over. This is a common investment mistake if you don't properly budget and you don't start with the proper mindset from the beginning, which is investing for the long term. One of the riskiest ways or riskiest mistakes that investors make is investing on margin. This means that you borrow money from the bank to invest more money into the stock market. If you have $1,000 and you have a margin account and you decide to invest $2,000, you can lose more money than you actually invested in, which is a very serious mistake for beginner investors. Why? Because investing on margin often is associated with a former mistake that we discussed, which is investing out of greed. They want to make another quick dollar, and they want to get as much money in this investment that they think is going to have a huge spike in the near future, and so they need to double down and buy more of that investment, even if it means using money that is not theirs, which is a major mistake and will 99% of the time end up in a failed purchase or failed transaction, and you lose money because you're not totally sure what you're doing as a beginner investor. Another common investment mistake is when beginners invest in companies or industries that they don't understand. A very common one of these is like a pharmaceutical company or a company that makes semiconductors or something that's very complex, and they really don't understand how that company makes money or how that industry makes money. A lot of people will invest in these types of companies or industries based on a quick news alert or something that tells them that they think that market is going to go up really quick and they want to get in quickly and make some money. But if you don't understand how that company or how that industry really makes money, then chances are you're going to make a bad investment decision. This has been taught by a lot of the most wealthy investors of all time, including Warren Buffett. So the advice here is to make sure you only invest in companies and industries that you know how they work and how they make money. If you're a financial guru or a retail professional with retail experience or whatever it might be, then you might invest in financial companies like banks, or you might invest in retail companies like Walmart or Target or something. But the point is to invest in what you know. One of the other major investment mistakes that beginner investors make is not doing proper research on a company that they're investing in if they're investing actively, which means choosing individual stocks. If you choose a company because it just simply seems like a good investment, or you've heard of a company before and you put your money into it and then you realize that that company is almost ready for bankruptcy, then you have just made a major mistake. What you need to do is make sure that you have analyzed the company's basic financials to understand where they are financially. It's just like a household. If a household has a lot of debt, not much money coming in, not much savings, and they're unemployed, chances are they're probably on a downturn for the moment and could potentially go bankrupt. The same thing is true with an investment company. You need to make sure that they're financially stable, that they have a strong market, that they have a strong product, and make sure it's something that you understand and you believe in, and something that is on an upward trend for the most part. So making sure you do your investment research beforehand is a major thing that you need to do beforehand, and that a lot of beginner investors don't do, which causes major problems in their investment portfolio. Last but not least, one of the bigger mistakes that investors make is not listening to the advice of more experienced investors. They think that they know something, or that it's different this time, that other people don't know, and they make investment mistakes going against the advice that they know they have been told not to do. 9 times out of 10, or 99 times out of 100, better said, when you ignore the investment advice that has been proven time and time again because you think you know better, you are making a very big mistake in your investment portfolio. Here's a quick summary of 10 beginner investment mistakes to avoid. Mistake number 1 is never starting. Number 2, choosing the wrong investment approach. Number 3, investing out of FOMO, or fear of missing out. Mistake number 4 is investing out of greed. Mistake number 5 is selling your investments out of fear. Mistake number 6, withdrawing investments for an impulse purchase. Number 7 is investing on margin or borrowing money to invest. Mistake number 8 is investing in what you do not understand. Mistake number 9 is not properly researching your investments. And lastly, mistake number 10 is ignoring the advice of experienced investors. So if you're a beginner investor or an investor just trying to better their skills, if you follow these 10 tips or if you ignore these 10 mistakes that common investors make, you will be on an upward trend and you'll be on your way to a successful portfolio. If you want to learn more about investing in the stock market, see our course called You Don't Have to Be an Expert to Invest in Stocks, and you can find it in the show notes below. You can also go to themoneyventure.com and click on courses at the top of the page. Thanks for watching. Till next time.